Hello, this is Rajat Bose here. I have come back once again for our 11th edition of stock recommendations, stock reviews and market outlook comprising Nifty, Bank Nifty and cnxmidcap. Keep watching. There would be quite a few reviews. There would be a couple of recommendations. We are here. We just had an eventful week. Lot of seesaw movement, mostly on the downside, but towards the end of the week, we had a ray of hope. We are going to review the Nifty. You know that in the last week, the Nifty fell every day, not on closing price basis. Maybe on Thursday it closed higher, but actually it opened much higher and then came down. So otherwise there had been very weak closes. So this is a very critical week that has gone by. Is the trend changing, or due to the US market getting bombed, tech stocks doing well, so Nifty survives in its uptrend? Since the previous Friday, 7th of July, after posting the then high of 19,523, the index has become somewhat range bound. It is with a moderate slant. The story is that mostly supply pressure, but with late session strong rallies. This indicates that there is continuous inflow of fresh money. Without fresh money coming in, the late session, all of a sudden about turns are not possible. Now display the Nifty daily chart. The Nifty daily chart shows that the index has been maintaining its uptrend despite regular intraday selling. On the last day of the week, the Nifty posted a fresh all-time high of 19,595.35 before posting a closing high of 19,564.50. Sectoral changes are happening as needed. One sector comes in, other sector goes. Earlier it had been the banking sector, this week it had been the technology sector. Banking sector ruled for April and May. After that it was some other sector, and now it is the technology sector, which is a late entrant. Once the dark clouds of inflation in the US seems to be going away, and along with that the fear of more than one Fed rate hikes, the technology stocks have come out of their slumber. On Friday, they took up the baton to push the Nifty higher, and so it did phenomenally. Despite intraday weakness, the 9-day EMA is not being tested even once in the last 11 trading sessions. The bulls have enough gumption to push the market, even if the high is made only in other sectors and banks are left behind, but the market marches on. With the current strength of the index, we can expect that a taste of the Fibonacci projected level of 19,767, and if the Nifty were to stay above that 19,767 level, it will be moving towards the next projected level of 2250. Yes, it can go there because it is sheer money power that is pushing things. So long as the 9-day EMA, currently at 19,374, gets decisively broken on the downside, expect all dips to be countered with fresh buying. Trend reversal based on current price movement can only happen if the index were to fall below the 19,000 mark. A close look at the weekly chart will tell you that this bull run in the Nifty is already 16 weeks old, yet it shows no loss of gumption even when it could spend almost the whole week facing strong supply pressure for most of the sessions till Thursday. Come Friday, it posted a new high with much more strength that was not seen earlier. The Nifty looks top heavy, but it hardly matters since it is trending up. Yeah, we come to the Bank Nifty. You know, Bank Nifty is the most problematic character. it is this index that is actually creating a lot of problems, unable to sustain at higher levels, almost getting below the 45,000 mark or trying to sustain above that. Throughout the week it suffered. So how does it look from various parameters? We are going to study. We will take up intraday charts, we will take up daily, weekly charts and see the bank nifty, how does it pan out from here. After posting a lower high of 45,417 on the last 75 minutes on 6th of July, the bank nifty was showing clear weakness and it was gradually sliding down. However, after touching an intraday low of 44,547, it shot up to take out the 9, 20 and 50 unit moving average on the 75-minute chart, and it moved to a high of 44,898. The real-time close was 44,891, but the adjusted close had been 44,819. It is heartening for the bank bulls for sure. Now, when you look at the year-to-date chart, that is the daily chart of the bank nifty, it becomes clear to you as to why I say that it is the weakest of the lot. However, it was the same bank nifty that was competing with the cnxmidcap neck and neck in the months of April and May. From June, it lost most of its upward momentum. The last week, it closed every day with a red candle, meaning the open was always higher than the close of the day. However, despite all its weakness, it has not yet tested the 20-day EMA even once. This is due to the bullish overtone of the market. To gain real strength, it needs to take out the 45,200 mark as a bare minimum. Watch its performance very closely. Check if it crosses this very important level on the upside. It is kind of the fulcrum above which the index would become bullish. The bearish implications of the gravestone doji pattern at the top seen last week on the weekly chart has not been negated. But as we have been discussing, we have not seen much of its bearish significance playing out. However, the weekly chart continues to remind us of a probable breakdown. Technically, the negative divergence in the weekly chart in both 14 RSI and the MACD oscillators and the gravestone doji at the top, together they form a very ominous sign of an impending trend reversal in the bank nifty. Even if it has not shown such a thing, we must always keep this in mind that something is amiss here. Things are not as hunky-dory as it appears to be on the surface. This guy is our, the strong man. It was performing brilliantly. And now let's see how does it really pan out. It was the leader. It even posted better performance than the Nifty. But would it sustain? Would it require a consolidation? We are not talking about a downtrend immediately because it was showing so much of strength. So will there be a consolidation, range bound price activity, or the uptrend continues as it has been for so many weeks? On the 75 minutes chart, it shows that the weekly low of 35,831 already happened by 12:30 p.m. on Monday, that was July 10th. The index started recovering to post a high of 36,546 by 10:30 a.m. Thursday 13th of July. It almost collapsed 550 points thereafter in the next 2.5 hours. However, it did recover in style to post a fresh high of 36,549 in the last 75 minutes on Friday, and finally at a higher closing price of 36,528.95. This must be giving you a clear indication that what kind of massive buying capacity the mid-cap bulls have. They are putting in money at the drop of a hat. Very rarely I have seen such a consistent uptrend that never tests its 20-day EMA in last 4 months even once. And only once it closed below the 9-day EMA on 23rd June. Such is the bullish gumption of the cnxmidcap 100 bulls. Whether it is happening through borrowed money, as I said in last week's review, or whatever the strength of this uptrend in the CNX midcap is something to remember. Nothing seems to matter. Corrections that happen here are mostly intraday. Intraday corrections do not mean much. However, don't be very upbeat, because the further it goes up this way, the riskier it becomes. I suggest part profit booking so that you are not caught unaware all of a sudden. The weekly chart of CNX Midcap shows that the latest close of 36,528.95 is higher than its 50-week EMA at 31,801.16. It is higher by roughly 15%. While it is not an alarming one, but it raises the greater probability of a correction. Given the fact that most retail money props it up, it raises the possibility of a sharp fall going forward, and that could be pretty nasty whenever that happens. If you have liked my presentation, if you liked the analysis, if you liked the discussion, then please don't forget to press the like button. Subscribe to my channel and also share it with others. And don't forget to press the bell button so that you get the recommendations from YouTube whenever I post a video. We are reviewing 3 stocks this week: Cipla, Tata Consultancy Services and Coforge. How are they doing? What you are going to do? How does it pan out? Keep watching. You will get the answer. First we take up Cipla. 3 weeks back we recommended Cipla at 1006 with a stop below 948. It has now moved to 1030 on the last close. As you can see on the daily chart, it is moving up slowly yet firmly. It has neither met its targets nor it has hit its stop loss of 948. I am quite comfortable with its low gradient steady uptrend to meet the targets eventually. My suggestion is to hold the long position with the same stop and expecting the same targets upward. Continue with it. Our second stock on review is TCS, Tata Consultancy Services. The technology major has been range bound for quite some time. It was oscillating between 3160 and 3360 throughout the last 4 months. It actually came up. It has made up for being range bound and not giving any movement. It has started moving from 3250 in the recent past, and it shot up. It shot up on Friday in a big way to close at 3525. We recommended this stock at 3302 with a stop below 3150. It did not hit its stop loss. Now it has met its first target of 3440 but could not reach the second target of 3550. The high on the last Friday was 3525 and the stock is showing enormous strength. It appears that the target would be met this week, that is the target of 3550 given its current momentum. I suggest continue to hold the stock with the same stop loss, and our target of 3550 would be met. Once that is taken up, once that is taken out, expect 3713, 3775 and 3838. These are technical targets and they are likely to be met also. Continue to hold TCS. Third and final review stocks is Coforge. Coforge was recommended on the last weekend of June. It was given a buy at 47.11 with a stop below 42.89. A stretch stop loss was given since I gave the final target. Target range was 5800 to about 6000. If that kind of a target is given, you need to have a large stretch stop loss. However, one thing is very reassuring. Its rounding bottom pattern on the weekly chart is gradually panning out. It is progressing in the expected manner. Continue to hold this stock with the same stop loss. Now the stake stocks are doing well again, so continue to hold on. If you have liked my presentation, if you liked the analysis, if you liked the discussion, then please don't forget to press the like button, subscribe to my channel, and also share it with others. And don't forget to press the bell button so that you get the recommendations from YouTube whenever I post a video. Our most interesting segment, at least that's what I gather from your comments in YouTube and also on other media, other social media. We have come to recommendations. This time again, we are going to come up with two more tech stocks. One of them is a software company, other, it is a technology stock. You will get to know about them very soon. They have a lot of potential. First recommended stock is a tech stock, a software stock. This is Telecom, Tech Mahindra. It has closed at 1228. I suggest a buy in this stock with a stop loss of 1048 on closing price basis. Targets would be 1435, 1608 and 1714. 6 to 9 months is the duration for the trade. Tech Mahindra has been range bound between 950 and 1150 for nearly 1 year. Only recently it has posted a breakout above 1150, the upper boundary of the range. The up move that has just begun is likely to sustain after a long consolidation. Now the stock is trending up. It is expected to post a quarterly earnings of roughly 13 rupees for the June quarter. Consensus revenue estimate for the June quarter is about 13,483 crores as per TradingView. It is also come dividend till July 21. The dividend amount is rupees 32. As I said in the beginning, I am recommending this stock at 1228 with a stop loss of 1048 on closing price basis. Technical targets remain at 1435, 1608 and 1714. Duration will be 6 to 9 months, could be even 1 year. To arrive at this bullish recommendation, I use the rounding bottom pattern that you now see on the weekly chart, and the levels are also assigned. Levels are assigned by Fibonacci retracement levels or Fibonacci forward projections. Good confidence that it is likely to meet its targets eventually. You heard the software stock, right? Now comes the next technology stocks. It has got a lot of potential. It has given a good dividend. It's already it was on an uptrend. It came down on a correction, and now after the correction, the move has begun again. Tata Communications. Tata Communications is our final stock. Tata Communications is a technology stock. Is a technology company engaged in telecommunications industry. It offers internet gateways for customers in Europe and Africa to connect with India. It has got quite a few marquee corporate customers like Pfizer, General Motors, Microsoft, Air France, Panasonic, Samsung, Hindustan Lever and HDFC Bank. These companies are among its customers. It does business in various locations, Singapore, UK, USA and other parts of Asia. Business in India constitutes about 43% of its total turnover. Its voice services given to international market, 99.3% of voice service given to international destinations. Data and managed services constitute 78.6% of its bulk transformation services. It is a good long-term bet provided you have the patience. Tata Communications fundamentally quite a good company. I would not say that it is consistent ROC above 40 or something, not that, but it is a fairly good company. I mean, fundamentally you can trust it. I recommend buying Tata Communication at 1623, the last closing price, with a stop loss of 1459 on closing price basis. Targets would be 1749, 1848 and 2119. Duration will be 9 to 12 months. Here we come to the end of our discussion. It had been an eventful week. It had its own positives as well as certain anxieties. We have covered them all. So you must have enjoyed listening to it and you have got some actionable ideas. Thank you for being with me. Keep watching and look for the next week.